If the United States were ever to default on its debt obligations, the global economic system would essentially halt within 48 hours. Banks would immediately freeze lending, markets would cease to function, and the value of every dollar would evaporate. The massive figure we call the U.S. national debt is far more than an accounting entry. It is the core operating system of modern global finance, supporting every transaction from your home loan to the price of basic commodities. A failure of this structure wouldn't be confined to America. It would trigger a global crisis of confidence, the demise of the financial architecture we rely upon. To grasp this existential risk, we must first examine the creation of this tower and why the world's wealthiest nation simultaneously carries its greatest liability. The story begins in 1790. The fledgling nation, newly free from revolution, was crippled by war debts owed to soldiers, citizens, and foreign lenders. Instead of declaring bankruptcy, Treasury Secretary Alexander Hamilton enacted a radical policy. He mandated the assumption and full payment of the debt. Hamilton correctly argued that a nation's ability to borrow and pay reliably was the key to securing international credibility, a vital asset in a volatile world. This bold strategy succeeded. The U.S. began issuing Treasury bonds, formal promises of repayment, and consistently honored them, quickly establishing American debt as the most coveted financial instrument in European markets. The young republic secured its future not just through military victory, but through unwavering financial fidelity. This trust became the engine of every subsequent American boom, from the expansion of railroads to the New Deal programs. Debt was reframed as a catalyst for growth, not a constraint. By the mid-20th century, this financial engine was commanding the world. In 1944, at Bretton Woods, 44 Allied nations met to define the post-war global economy. They made the monumental decision to peg the global system to the U.S. dollar, which was, in turn, convertible to gold. With the U.S. possessing two-thirds of global gold reserves and unrivaled industrial power, the dollar's stability was absolute. Foreign nations amassed dollars as reserves, and the ultimate safe harbor for investment became the U.S. Treasury bond. America's debt became the world's most reliable asset. Yet absolute faith is perishable. By the late 1960s, a costly war in Vietnam, combined with expensive domestic spending, meant the U.S. was issuing more currency than its gold reserves could credibly back. Nations began cashing in their dollars for the metal, rapidly depleting the Treasury's vaults. The climax arrived in 1971, when President Richard Nixon unilaterally terminated the dollar's convertibility to gold. The link between money and a physical commodity was broken. From that moment, the dollar's worth, and by extension the entire global system's stability, rested solely on the faith in the U.S. government's commitment to repay its debts. This act instituted the debt standard. U.S. Treasuries became the de facto global collateral, not because they were intrinsically risk-free, but because every major financial actor from banks and pension funds to central banks agreed to treat them as such. The national debt is therefore the unseen infrastructure of global liquidity. Every major interest rate and financial contract is calculated upon it. The system functions through a continuous, perpetual rollover. Old bonds mature, and new ones are issued to replace them. As long as this process remains unbroken, stability persists. If this cycle ever fails, if even a single payment is missed, the faith underpinning the system immediately dissolves. Treasuries are the collateral for global banking. A U.S. default would instantly reprice the safest asset as highly risky. Within hours, liquidity would vanish. Banks would stop trusting each other. The dollar would plummet. It's happened before, on a small scale. In 1979, a processing glitch delayed Treasury payments for just a few days. Interest rates spiked immediately, and the shock lingered for years. The great irony of American power is that it cannot eliminate its debt. The world relies on it as the stable base layer. Debt is the indispensable product. However, even infinite trust is not immune to erosion. With U.S. debts soaring past $38 trillion, annual interest payments now approach $1 trillion, nearly equaling defense spending. The government is borrowing to service previous borrowing, a clearly unsustainable trend. Meanwhile, repeated political brinkmanship over the debt ceiling has turned the foundation of global finance into a domestic political weapon. Investors are growing wary. Key foreign buyers, including China and Japan, have begun to cautiously reduce their Treasury holdings. Central banks are diversifying their reserves, quietly favoring gold once more. Countries worldwide are actively developing trading mechanisms that bypass the dollar. For the first time in decades, the world's faith in U.S. stability is visibly cracking, not due to lack of resources, but due to lack of political cohesion. When trust is the only reserve, politics is the ultimate financial risk. A U.S. default wouldn't initially be a chaotic crash. It would be a chilling stillness, a single technical glitch, a missed payment explained away. But instantly, every trading terminal, every bank, and every algorithm would register the fact that the unthinkable had occurred. The world's safest asset is unsafe. In the first hour, markets would freeze. If treasuries aren't guaranteed, the world's financial plumbing would seize instantly. Stock prices would plunge, not because companies stopped making money, but because the foundation of valuation would vanish. Then the panic would move outward. The dollar would collapse as investors flee into gold, euros, or even crypto. Interest rates would skyrocket, making all credit mortgages, consumer loans unaffordable overnight. The USS second. Government would be unable to meet its domestic payment obligations. Within 2 weeks, the entire global economy would be in cardiac arrest. And yet, the real story isn't about numbers, it's about faith. Because the U.S. doesn't just print money, it prints trust. And if that trust breaks, there's no central bank on earth big enough to fix it. Every empire in history has faced this moment. The eventual fall of the American system, as with Rome's denarius or Britain's pound, will not begin with invasion or revolution, but with diversification and indifference. The world won't fight the dollar. It will simply stop needing it. Each passing crisis, each political standoff, chips away at the essential idea of U.S. permanence. The longer the nation treats its credit as a tactical weapon instead of a sacred duty, the more its most powerful asset risks becoming its defining vulnerability. The United States built its empire on a paradox: boundless debt, supported by boundless trust. That trust, though depreciating with overuse, remains its last and most vital currency. If the U.S. ever fails to pay, it defaults not just on its creditors, but on its own historical promise. The world doesn't run on money. It runs on trust. And trust is the one currency no nation can print.